Good evening, this is the Town of Monroe Pension Committee and OPEB Board of Trustees regular meeting. Today is Thursday, July 31st, 2025. The meeting is being recorded and will be made available on the town's website pursuant to state law. I'm going to proceed to take roll call. For pension, Terry Rooney.
Here.
Steve Kirsch.
Here.
Joe Cobson.
Here.
Frank Devos.
Here.
Jonathan Formigella.
Here.
Dennis, no, and Jason Maurer and Kristen Martinez. Really? Heidi Mead. Here. And then for OPEB, Ron Banowski.
Here.
Terry, you're there, and Jonathan, and Mike is not here for the record. And then our advisor from fiduciary, Devin.
O-N.
Okay, so first up is, do I have a motion to approve the pension committee regular meeting minutes and voting record from January 23rd, 2025?
Steve Kirsch, so moved.
Have a second?
Second.
Any discussion? Hearing none, all in favor?
Right.
Do I have a motion to approve the OPEB Board of Trustees regular meeting minutes and voting record from January 23, 2025?
So moved.
Second?
Second.
Any discussions? Hearing none, all in favor?
Aye.
All right, moving to new business, we have our quarterly investment review. I think we're starting with second quarter. Are there any notes from first quarter with Devin?
No, I'm certainly happy to answer any questions, but I think it makes sense to talk about year to date.
All right, so I'm going to turn it over to you.
Okay, wonderful. So you can open up. Before we get into the meat of the presentation, I'll just take a pause on page 2. I think as everyone is aware, we service a lot of municipal pension plans, but we also have other lines of business. We service 401k plans, corporate pension plans, endowments and foundations, and then we also have a private wealth office. So if you look at the electronic version of the report, these are all live links in case any of these pieces of content are interesting to you. And then also we have our annual investor conference, which is in Boston this year. So we kind of flip-flop between the East Coast, usually Boston, and Chicago. So this year it's in Boston on September 17th with a reception the evening before. So we would love to have any and all of you join us if you are so inclined. Okay, so moving ahead, the fiduciary governance calendar on page 6. This quarter, it is very straightforward. We have an expense review. For clients that have exposure to less liquid assets like hedge funds or private equity, we also include a liquidity review, but in the town of Monroe's pension and OPEB plans, everything is a daily value mutual fund, so we don't have that liquidity analysis. So we have the overall expense review. The snapshot is shown on page 7. So we break out not only investment portfolio, so the underlying investment management expenses, we also detail the custodial costs, which are charged by principal, and then fiducian's fee as well. So the investment management fees are shown at the top of the table on page 7. Both the town and Board of Ed pension plan come in at 44 basis points or 0.44% for the underlying investment management costs. And then the OPEB plan has much more passive exposure. So other than a couple active fixed income managers, it's all passive exposure within OPEB, which is why it's much cheaper at only 16 basis points. Then principal charges 3 basis points on assets, and then you have a couple per account fees and so on and so forth. And fiduciant for the pension, we charge a flat fee with an annual inflationary escalator. So as of the most recent annual fee that comes in at about $44,000. If you translate that into basis points based on the approximate 26 million, fiducian's fee is about 13 basis points or 0.13%. And then for the OPEB, we charge 25 basis points with a minimum of $3,500. So if we think about the all-in costs of the investment program, let's take the pension first. You've got investment management costs at 44 basis points or 0.44%. You have custodial costs at 3 basis points or 0.03%. And then you have fiducian's cost of 0.13%. So you're all in for the pension at 0.6% or 60 basis points. So we like to, a lot of times people say, well, what's good? And it's hard to benchmark these types of things, but we want our clients to be decidedly below 1%, and you're well below that all in. And then for the OPEB, you take the 16 basis points for investment management costs, the 3 for custodial, 25 for fiducian's fee, and you're all in at 0.44% for OPEB. So we think, very reasonable fees across the board. If you look at pages 8 and 9, actually, and page 10 as well, these are all pages that exist further back in the report, and they're in every quarterly investment review, but this just details the underlying investment management fees. So the 0.44% that I mentioned for the 2 pension plans, and then the 0.16% of investment management costs for the OPEB, you can see all of the underlying detail for each individual mutual fund that's held within the portfolio. And, it's pretty typical. One of the things when our research group is doing due diligence and analyzing potential investment strategies for use in our clients' portfolios, fees are something that we consider. But it's not, the driving force. So we won't necessarily choose a fund just because it happens to be the lowest cost option. And then likewise, we won't necessarily eliminate a fund just because it happens to be more expensive. It is typical. You can see when you look at the analysis that the more nuanced or kind of niche an asset class is, the more expensive the investment strategy tends to be. So it's much more expensive to run an emerging markets fund, for example, rather than, a typical fixed income fund, because you've got to have analysts on the ground in those emerging market countries doing the fundamental research. So, naturally it's more expensive, but fees are something that we pay attention to and, continuously trying to negotiate fees lower on behalf of our clients. Okay, any questions about the fees before we just take a look at the funded status snapshot?
As an aside, Deborah, that was very helpful.
Oh, good. I'm glad.
That was very helpful.
Okay, great.
Yeah, I don't have anything over 1. So
Yeah. Great, you're well below. Okay, so page 11, snapshot of the funded status. You only do the Val report every other year, and so 2024 is the most recent valuation report. I will point out that the funded ratio is over 99% for the 2 pension plans, which is pretty remarkable. That's definitely well above median across the state of Connecticut. So very well done. And the actuarial return assumption is 6.75%. I know that's something that we've discussed over the years, potentially bringing that down. That 6.75% we think is reasonable and justifiable and is basically right in line with median. And then the OPEB plan is the best funded OPEB that I have seen. So most OPEB plans are at about 40% or so funded. So with the town of Monroe's being over 95%, that's very impressive. You've been consistently contributing to that plan, so that's excellent. And again, a reasonable return assumption of 6.5%. So you are doing great in terms of the health of the funded status. And we've had, obviously this report will be talking about the most recent fiscal year results, and you'll see that the return of the portfolios has been strong over the past fiscal year. So we should see probably an improvement in funded status.
Where do you see the funded ratio for other towns?
The average across the state of Connecticut is about 75%. Yeah, so you're well above that. Yep. Okay.
Except the state plans themselves.
Yeah, God, yeah, 30 or something like that is even.
That's NTRB, yeah.
Yeah,
Mm.
it's sad state of affairs. All right, so let's talk about the markets. I won't necessarily go through each of these charts that begin on page 13. Just broadly speaking, so far this year, we've seen a lot of volatility in the markets. a lot of the market activity has been driven by the political environment. Obviously, we have a new administration, lots of new policies coming into effect, and that is contributing to a lot of the activity that we've seen in the market. In Q1, we actually saw negative results for domestic equities. Pretty sharply negative. There was a lot of, headlines about how poorly the markets were performing. But believe it or not, a diversified portfolio in Q1 actually held up okay because aside from domestic equities, most other areas of a diversified portfolio were in positive territory. So Q1 was definitely mixed. Q2 really pretty much strong results across the board. We'll get to that in just a minute. But there were a lot of ups and downs throughout the quarter. So Q1 ends on March 31st, April begins Q2. On April 2nd, we had Liberation Day, the announcement of all the new tariffs, which came as a shock to markets, and we saw a very significant market sell-off. Some areas of the market even moved into bear market territory, so down more than 20%. So small caps, for example, were down in that 20+% arena. And then 1 week later, on April 9th, we had the announcement of the 90-day pause, and markets bounced right back up and basically shook off all that fear that resulted from Liberation Day. So that's what colored the first month of Q2. And then, of course, the kind of the second half of the quarter was colored by the One Big Beautiful Bill Act and, the uncertainty as to whether or not it would pass, some concern over the increase to the deficit. So it's definitely, we've seen a lot of volatility under the hood. But largely speaking, as I said, markets have been in positive territory. One of the things that has been really driving headlines, and I'm sure you've either read about it or heard about it, is this tension between the executive branch and the Fed.
What are you talking?
Yeah. In case you're not familiar. So President Trump has been putting a lot of pressure on Jay Powell, the chair of the Federal Reserve, to lower interest rates. The Fed has always maintained that they are data driven. They have a dual mandate. They're looking for full employment and 2% inflation. We have been at full employment for quite some time, but we've been above 2% inflation. The Fed began cutting rates last year, but then with the onset of these new tariffs, which are expected to be inflationary, the Fed did not and still does not feel comfortable lowering rates because the expectation is that inflation will increase rather than move down towards that 2% target. So they had their most recent meeting yesterday. Again, the Fed held steady, although there were two governors who dissented, which is kind of noteworthy. But the markets really value Fed independence. And so we saw some volatility in the first quarter when President Trump indicated or suggested that he might fire Chair Powell. Markets actually sold off pretty significantly when that happened. And then he kind of walked back those comments after seeing the market reaction. So he has in recent history said that he intends to keep Powell in place. And I think investors are kind of comforted by that, but there's still a lot of pressure being put on the Federal Reserve. So the expectation is that they'll probably cut rates in September. We'll see how that shakes out. On page 14, you can actually see on the left-hand graph that in addition to getting pressure from the White House, there also is a little bit of peer pressure because other central banks have been cutting rates overseas. And so that's another thing. Well, okay, maybe the Fed will have a little bit more pressure to bring interest rates down.
They've been pretty significant in their cuts overseas.
Yes. Yeah, absolutely. And that puts, wind in the sails of an economy. So it's been difficult for people to, get a mortgage so it impacts people. Credit card rates are high and, it definitely has an impact on the economy. But you can also see why the Fed wouldn't feel comfortable cutting because they, hey, we've always said we're data dependent and inflation remains above our 2% target. generally speaking, you have rate cuts when the economy is in a bit of distress, and we've actually been on pretty solid ground. So it's that the motivation to cut right here now is not exactly there, but probably September. So we'll see. So page 15, I've mentioned a couple times that diversified portfolios are actually in pretty solid territory so far this year. So the bubble represents the return for the quarter, but the bar represents the year-to-date return. So
Can we just go, I'm sorry, can we just go back to,
sure.
because on 14, it's showing that one graph where we are versus the UK, China, Canada, and Europe.
Mhm.
But so those are the target rates, right?
That's where
That's-
their
that's
short-term
right.
rates
Yeah.
are. Yeah.
The target rates for the central banks.
Yeah,
right?
yeah, yep.
Okay, but like, I guess what would probably be helpful is like, where is like, CPI in each of those?
Oh, in each of those areas. Yeah.
Because, there's kind of a correlation there, right?
Right.
I mean, if you're, like, if the United States' CPI is the same as Canada's and their rate, I don't know if it is or it isn't.
Right.
It kind of would show that, hey, maybe our central bank should. Does that make sense?
It does make sense. Yeah, that would be interesting to look at. I can float that idea to our manager research group. They're the ones that put together this quarterly slide deck. But yeah, you're right. And also, the central bank in each of these various regions doesn't necessarily have the same goals and objectives that our central bank does.
Right.
So yeah, that's a good point. So page 15, the bars represent the year-to-date return. So for the first 6 months of the year, obviously the big standout when you glance at this page is the strength of international markets. International developed markets up more than 19% so far this year, emerging markets up more than 15%. Part of that has been a weaker dollar. So the dollar has weakened by about 11 percentage points or so far this year. However, if we look at international returns in local currencies, they still are outpacing US markets. So we've seen really strong results from international equities. In our view, this has been a long time coming. Domestic markets have outperformed international, for the last 15 years or so. So a bit of a reversal in that trend. Within US markets, you can see large caps are now in positive territory, up 6.1% year to date. Again, in Q1, they were negative, but then you see that bubble up more than 11% in Q2, which brought large caps into positive territory. Small caps remain in negative territory, even despite a strong bounce back in Q2. We still are constructive on small and mid cap stocks. They are more attractively valued. They don't look as expensive as large caps. And also, if the Fed does begin to cut interest rates, small cap companies should be the bigger beneficiaries of falling interest rates, because smaller companies tend to be more heavily reliant on debt. So as the cost of servicing that debt comes down, that's a tailwind for small cap companies. But it's certainly been a tough go for them so far this year. And then on the left,
I was gonna say, we've seen a little strengthening of the dollar in the past week or so. Do you anticipate that will impact the international funds a little bit coming down?
I don't think we'll see negative results from international,
No.
but sure, a stronger dollar is a headwind. Yeah. And actually, I'm glad that you mentioned that, Frank. So if you look at page 14 on the right-hand side, the graph further up, there's been a lot of talk about the weakness in the dollar and how it's fallen so far this year. But if you look at the long-term averages, we're still above the 20-year average. So the dollar is still quite strong relative to history. So we don't necessarily think it's going to weaken further. We don't necessarily think it's going to bounce back up to where it was, but kind of these levels where it currently, it's not anything remarkable that's like, oh my gosh, the dollar has to fall or the dollar has to rise. It is kind of within the realm of reasonability in terms of history. So fixed income on the left-hand side of page 15, all those navy blue bars. There's been a lot of volatility within the fixed income markets and a lot of, interest rates jumping around. Every time there's, some big announcement that the markets don't like, then there's a flight to quality. And then, so a lot of underlying noise going on. But broadly speaking, most areas of fixed income have been pretty strong so far this year. You can see the core bond index up 4% for the first 6 months of the year. And then on the far right-hand side, we've got diversifying assets like REITs, real assets, commodities, hedge funds, and most of those are in positive territory year to date. So if you kind of take all of this in, you can see that a diversified portfolio has held up quite well so far this year, even though if you were to just kind of isolate the, Wall Street Journal headlines, you might not have expected positive results so far. So I'll skip ahead a few slides and move to page 21. And I think I always pause on this chart, but this is the quilt chart or the periodic table of returns. And it just hammers home the importance of having a diversified portfolio. So what we see is each column represents a calendar year with the best performing asset class at the top of the column, all the way down to the worst performing asset class at the bottom. And there's really no discernible pattern. You don't know if last year's best performer is going to be the best performer again this year, or if they're going to be the worst. But what you can see is that a balanced portfolio shown in the orange box is always kind of middle of the road. So you help preserve capital by reducing the volatility over the long run. And that's, of course, what we've done for the pension and the OPEB portfolios. All right, any questions about capital markets or anything you'd like to talk about in more detail before we look at the portfolios? Okay, great. So if we move ahead to page 24, this shows a snapshot for the town pension and then the Board of Ed pension. So let's see, on page 45. Yep. So 24 and 45, and as you know, these two portfolios are positioned exactly the same. So I'll just use the town plan as a proxy. So year to date, the portfolio is up 7.6%, and on a 1 year basis, up 11.9%. So again, putting things in perspective of the actuarial return assumption of 6.75%. You well exceeded that for the fiscal year, so that should help improve your funded status. So it's possible that you might be over 100% when the next valuation report is done. On a 3-year annualized basis, again, well above that return assumption, you're at 12.2% per year over the last 3 years, 9.4% per year over the last 5 years, so on and so forth. And also, I just wanted to flag that we have now hit our 10-year anniversary with the town. So happy anniversary. It does seem, Ron, does it seem like 10 years to you? It doesn't seem like 10 years to me, but I don't know.
Seems like 20 years. Not the relationship.
I'll try not to take offense at that. So yeah, well, absolute returns have been good. Relative returns in terms of comparison to the benchmark, we're a little bit behind on a 1 year basis, but longer term, we're ahead of the benchmark. So that's great. And then in terms of dollars, you can see on the top right-hand side that the portfolio, so again, this is for the town plan, ended the quarter with just about 16.4 million. And we see the asset allocation profile. You can see it, the two graphs on the bottom of page 24, and then the whole page on page 25. So we have about a 70-30 target allocation within this portfolio. So about 30% fixed income, 70% return seeking assets. So you'll see as of the end of the quarter, we were a little bit overweight short-term liquidity. Just as a reminder, we replenish the cash position on a quarterly basis. So we'll build up enough cash so that we can make pension payments for a 3-month period. And then those funds go down and then we replenish them at the end of the quarter. So when you see a large cash balance, that's just indicates that we're holding that to be able to make pension payments. And then you'll see a little bit of an underweight to domestic equity, slight overweight to international equity, and that's really reflective of market movement. When we raise the cash for those pension payments, we always look at the target allocation and we say, okay, this area is overweight, this area is underweight, and we raise cash accordingly. So we kind of organically get back into balance. And then you can see the underlying holdings on page 26. So nothing has changed in recent history. So we've got 4 investments within the fixed income portfolio. The 2 core holdings are the Harbor Core Bond Fund and the Baird Aggregate Bond Fund. Both of those will behave most similarly to the aggregate index. So, just kind of the broad domestic fixed income markets. And then the 2 diversifying strategies are, we have a small allocation to TIPS, which are linked to inflation. And then the BlackRock Strategic Income Opportunities Fund, that's an unconstrained fixed income fund. It has exposure to global bonds. It has generally a shorter duration, a little bit more defensive profile. So having that diversification has been helpful. And then on the domestic equity side, we've got passive exposure in the large cap domestic equity space through the Vanguard 500 fund. And then we have 2 active managers on the small mid cap side. So Diamond Hill is the value approach and Conestoga is the growth approach. And then international equity is all active. We think it's really important to have active management, a manager that's doing the fundamental research on the international side. So the pairing within the developed markets is Dodge and Cox on the value side, John Hancock, which is sub-advised by Axiom on the growth side, and then a similar pairing within emerging markets. Arga is the value manager, GQG is the growth manager. And then finally, the last piece of the portfolio is the principal diversified real asset fund that has exposure to infrastructure, commodities, REITs, TIPS, basically everything within the real assets universe. So again, thinking back to that quote chart, you've got the broad diversification that we think is important to help reduce volatility over time. Page 27 is a new page, so it may not look familiar to you. This just shows a breakdown of the fixed income exposure. So within your portfolio, this shows all of your underlying fixed income managers, the average yield, the duration, credit quality, so on and so forth. So, you're finally getting paid for fixed income these days, which is nice. You have a weighted average yield of 4.5% for the fixed income portfolio, and the vast majority are in investment grade securities. So a pretty high quality portfolio.
5.6 from Fidelity on a fixed income is very nice.
Yes,
Very
yeah,
nice.
that's the TIPS fund. Yeah, so yeah, that is, it's nice to have that. All righty, so one thing I will point out, we've got a few pages in here for attribution. We've got a lot of pages in here for attribution. So it starts on page 29 and ends on page 33. So let me just, I'll focus on the 5-year. So if we look at page 31, and let me just tell you how to read this. So this kind of peels back the layers of the onion and says, okay, as we evaluate the portfolio and look at it over a long-term time horizon, what's working, what's not working, how are we holding up? So the way that you start to read this is, let's start at the top half of the page and towards the left-hand side. And I'm going to work my way up from the bottom. So total fund, that is the performance of this pension portfolio, up 9.4% annualized over the past 5 years. You move one step up and you look at the benchmark. The benchmark is up 8.7% annualized over the past 5 years. And so then you have 70 basis points of relative outperformance. So we're beating the benchmark. Okay, what's contributing to that outperformance? Has it been asset allocation positioning? Has it been manager selection, or has it been something else? That other category is basically like market timing, or the timing of contributions or distributions, or trading, those sorts of things. So on the top right-hand side, you can see asset allocation and other have had a kind of a negligible effect. It's been manager selection that has been the most additive over the past 5 years. Then you go down to the bottom half of the page and this gets even more granular, all the way on the left-hand side where you see the teal bars that say average active weight. That means compared to our targets, have we tended to be overweight a certain asset class or underweight? And then right next to that, with the asset allocation value add, has that overweight or underweight contributed to results or detracted from results? So for example, we have tended to be overweight short-term liquidity because we have a 0% target to money market. But again, we do tend to hold cash as we are awaiting pension payment distributions. That overweight has detracted from results because the broad markets have performed much better than fixed income. On the flip side, we've tended to be a little bit underweight fixed income. That has actually contributed because fixed income, although it's performed pretty well, has not kept pace with equity markets. So having an underweight to fixed income has been helpful. So then you can, go down. We generally stay pretty close to the target allocation. So really the allocation effect shouldn't be too significant over time. So then if you look on the far right-hand side with the blue bars, that shows the manager value add. So in certain areas of the portfolio, where have the active managers been most beneficial and where have they perhaps struggled a bit? So the biggest outperformer has been within fixed income. You can see that's contributed 0.6% over the past 5-year time period. The domestic equity managers have underperformed, and that's really been a reflection of the market environment where we have a little bit of an overweight to small and mid-cap managers, and the large cap space has been the place to be within domestic equity. So that small and mid-cap allocation has detracted a bit in relative terms. And then the international equity managers have contributed on a 5-year basis. So that's how to read this. And, we don't need to go through every single slide, but we do tend to include these once a year usually. Any questions on that? Okay. So on page 34, you can see that all of the managers in the portfolio are on maintain status. We don't have any concerns. There have been no organizational or team changes that we're concerned about. And performance has been, as we would have expected. So page 35 up until page 37, this shows each of the asset class results as well as the underlying investment manager strategies. I don't need to go into all of these, but as I mentioned, fixed income has been one of the strongest pieces of the portfolio. So you can see that the fixed income managers collectively over the past year have been up 6.6%. The Barclays Aggregate Index has been up 6%. So you have about 60 basis points of relative outperformance over the past year. And then going on over a longer term time frame, you can see that fixed income collectively, your managers have been ahead of the benchmark over all time periods. And probably the most helpful manager has been the BlackRock Strategic Income Opportunities Fund. That's that unconstrained go anywhere fund, tends to have a shorter duration profile, which in recent history has been quite helpful. So you can see, for example, over the past 5 years, when the two core managers are actually in negative territory on a 5-year basis, the BlackRock fund is up almost 4% annualized because of their defensive nature. Moving on to domestic equity. So the top of page 36, collectively, your domestic equity managers are about in line over the past year, up 13.5% compared to the benchmark, up 13.7%. And again, you've got some mixed results from the small and mid cap, and just generally speaking, small and mid cap stocks have not kept pace with larger cap stocks.
Just
go ahead.
Again, looking at taking a personal view, I've played with the Russell over and over again, thinking that it's gonna finally do something, and it never quite does. I'm just wondering, is we keep it in our mix. Is there a feeling that it's gonna do something in the near term?
We do think so. I mean, near term is hard to say. So when we build our capital market assumptions, it's based on a 10-year outlook.
Yeah.
And our return expectations for small cap, I think, are somewhere in the neighborhood of like 8.5%. And our return expectations for large cap are like 5 or 6%. So we think that there is a higher expected return, but to your point, Frank, it has not materialized in
No,
recent history.
I just,
Yeah,
What are you talking, Russell, the value?
well, it's talking about the performance of small caps compared to the rest of the market.
so either Russell 2,500, broadly speaking, Russell 2,000. So if we go back to, let's see, page 22. You can see, so like the S&P or the Russell 1000 are the large cap areas. And then if we compare those returns to either mid cap or the Russell 2000 or the 2000 growth or value, large caps have been the place to be. We don't think that will continue forever. If you look at valuations, large caps are much more expensive, but they're also more heavily weighted towards tech, and there is a case to be made, and many people have made this case that maybe tech is going to be the only game in town on a go forward basis, and if the smaller companies don't have as much exposure, they might continue to win.
Again, if we see some interest rates coming down, if there's a significant move, that will benefit small cap.
Absolutely, yep. So, and it could be short term.
Yeah.
Maybe it's not going to be a lengthy outperformance like we've seen, but they could, bounce back.
And I understand balance.
Yeah.
It was more personal perspective.
Right, yeah.
In terms of.
No, it has been frustrating, just like, people were getting really frustrated with international exposure. Finally, for the first 6 months of the year, it's worked, but for 15 years, it lagged, but you do have to have that discipline of diversification and, the belief in mean reversion, I guess.
Okay.
Yep. So speaking of international equity, if you look at that year-to-date column, compare your domestic equity composite up 4.3% and your international equity composite up 17.2%. So international has significantly outperformed domestic so far in 2025. That also bleeds into the 1-year results where international markets are up, your portfolio is up 16.2%. A little bit of relative underperformance on a 1-year within international, but you're well ahead on a 3-year basis. So again, we've got the mix of active managers within international. They've all done pretty well, with the one exception of GQG, which has really struggled so far this year. Basically, everything that is working for ARGA is the opposite of the way GQG is positioned. And so GQG has had an underweight to China. They were underweight South Korea, which was the best performing area of the emerging markets arena, and significantly overweight India, which has really struggled. So that's why you see that like the near term negative results. What's really interesting is GQG has it's a pretty concentrated portfolio, only about 50 names, and they tend to have a ton of tracking error. So they don't manage themselves to the emerging markets index. So you see on a 1-year basis, they're about 20 percentage points behind the index. But then you look on a 3-year annualized basis, and they're actually 2 percentage points ahead on a 3-year. So that just goes to show how strong the first 2 years were in that 3-year period. So over the long run, we like their strategy, but we acknowledge that it does tend to be very volatile. But we have conviction they're still our international equity analysts. It's GQG is their highest conviction EM growth strategy. So very tough 1-year period, but we still like them, and we are not recommending a change. And then finally, the principal fund. So that's that real assets fund. They are more defensively positioned. So that's why you see some relative underperformance compared to the blended index. But they are serving the purpose that we use them for, which is to provide that diversification, that uncorrelated return stream. So we're comfortable with that position as well.
Well, regarding GQG, what
Yeah.
would at this point, like how patient should we be with that?
Yeah, so the way that we tend to not put managers on watch or terminate status simply due to underperformance, as long as the underperformance is consistent with their stated philosophy. So if we know that they make high conviction bets that don't match the benchmark, then we're willing to accept tracking errors. So we could see, if India continues to struggle, if South Korea continues to outperform and GQG doesn't have the doesn't have the right exposure, they could continue to struggle, but so it's more of an art than a science. It's not like, okay, 4 consecutive quarters of underperformance and you automatically go on watch status. That's not the way that we handle things. What we'd be more concerned about is if we saw them trying to chase returns and deviating from their stated process. But our analysts are talking to them on at least a quarterly basis, if not more frequently. So if we start to see some cracks in the foundation or a stubbornness and unwillingness to accept failure, like, okay, these 5 names have dragged you down over the past 3 years. Like, what's the turnaround story? What's the catalyst? Or when are you going to get rid of them? And if they are like so committed to holding on to those names, almost like to the detriment of that's when we would start to lose conviction but it's hard to say that there's like a specific time period.
Sure.
Because once we do put a manager on watch, we have to basically fish or cut bait within 4 quarters. So a manager can't stay on watch for more than a 4-quarter period of time. Then it either has to go back to maintain or it goes to terminate. So we're pretty patient leading up until that point, because then we know that the clock starts ticking.
Right.
So we're keeping an eye on it, but we do acknowledge that the 1-year number looks pretty awful. But again, we think about, the way that we build portfolios is GQG is positioned very differently from ARGA, and that makes them a good pairing because they kind of, balance each other out. So Board of Ed, all the same underlying managers, basically the same performance profile, just a little bit more in terms of assets. So you can see on page 45 that they ended the quarter at 17.5 million. But basically all the same things apply to them. And then OPEB, the OPEB review starts on page 64. So just to give you a sense of where, so you'll see, let's say on page 67, you'll see that there's a pretty significant cash balance, just over 5% of the portfolio. It was in cash as of the end of the quarter. That's because the contribution was made during the month of June. So that was still sitting in cash as of the end of the quarter. So we are doing a dollar cost averaging strategy because this represented a pretty significant percentage of the overall portfolio. So we invested 75,000 in early July, and then we'll do another 75,000 in early September. So half of that money has already been put to work, and the other half will be put to work in September. So other than that, we're pretty much in line with the target allocation. And you can see the results up on the top of page 66. So over the past 1-year time period, this portfolio is up 13.4%. And again, you think about that in terms of the return assumption at 6.5%, you've significantly outperformed. And then the longer term results are ahead of that return assumption as well. The market value as of the end of the quarter was just shy of 3.3 million. And you can see since inception, going back to 2018, so not quite that 10-year time period, but you started with only 700,000 in the portfolio, and the town has made contributions of more than 1.6 million. So you do have that consistent and disciplined practice of contributing to the OPEB. And then you have, of course, the investment gains, which have also driven up the portfolio value. And so page 68 shows the underlying investment holdings. So we've got two of the same fixed income strategies. We have Baird, which is again, one of those core, more traditional fixed income holdings. And then we pair that with the BlackRock Strategic Income Opportunities Fund. Those are the only two active managers in the portfolio. Other than that, we have everything in index funds. So we've got large cap, mid cap, and then international equity, both developed and emerging markets. And then REITs is the final piece of the portfolio. So again, we don't have any recommended changes for any of the portfolios. In terms of the fiscal year results, you're looking at very strong results, well ahead of the return assumption. And, we think that the portfolios are in good shape, the asset allocation is appropriate, and don't have any recommendations for things. Any questions?
Thank you.
You're welcome.
All right, next up, we have the summary plan descriptions, the retirement plans for the town and board of Ed participants.
So, the thought, we were having those worked on by the, pension attorney for the town, and the HR directors and myself have already given them a preliminary review, and the thought was to, give them to the pension committee and have them review them over the next quarter. My thought was to funnel any questions to the chair, and we can discuss them and hopefully vote on a
Yeah, so both documents have been emailed if you haven't checked your
Yeah.
emails.
yes.
So if there's any comments, questions, tracking changes. you
My
can send them
question-
my way.
My question is, I looked through it very quickly today, Ron.
Yep.
The easiest thing would be highlight where there are changes from previous version.
So these are, let me give you a little bit of the history of these
Okay.
documents. They were the town side summary plan description was started about 6-7 years ago internally and passed off to the pension attorney. And the human resource director at that time left and just kind of left in limbo and never completed. Then we were in negotiations on the Board of Ed side, and one of the bargaining units asked for a summary plan description, and none was ever prepared. So these are actually
Brand
they're
new.
developing brand new documents. Okay. So that's about the best history.
Well, is there any area in particular that you would like to see us focus on? Or it's new territory, look at it all?
Yeah, it's kind of new territory, look at it all, and this board should, this is a document that is gonna go to now the plans are frozen, but there are active participants in the plans. And there is a disclaimer on the front page that the pension plan is the, legal document, so, but they, my best, advice is to look at the whole document, yeah.
And if a participant requests that you have to furnish a copy, then.
The summary plan descriptions, I think, are gonna be given to everyone.
Okay,
The actual pension plan will be made available upon request.
okay.
Um,
Does anybody want a paper copy?
Rebecca wants a paper copy, so.
If you're doing it, I'll take it.
Yeah.
So after the meeting, I can, I'll take an account and, make sure anybody.
Okay. So, all right, that's everything, so motion to adjourn. Motion. Second.
Second.
Thank you.